Tonight we're diving into international trade, and why the US is suddenly getting the cold shoulder from its biggest partners. Our key trading partners are quietly reducing what they sell us. It's like being unfriended, one container ship at a time. This isn't a blip, it's a trend. Global supply chains are being rewired, and the US is increasingly left out. Meanwhile, Canada just signed a massive deal with us, bucking the trend. So, what's really happening? Are we being isolated, or is this just the chaos of a new global order? We'll break it down country by country to see why everyone seems to be swiping left on Uncle Sam. We'll also look at Canada, the loyal friend doubling down while others pull away. Grab a snack, preferably not imported. Let's get started. Let's start with China, the world's factory for decades and America's go-to supplier for everything from phones to sneakers. But that fire hose of goods is slowing to a trickle, and it's no accident. The US-China trade war kicked off a wave of tariffs and retaliation, but the real shift is deeper. China's new strategy: rely on its own market, build its own tech, and reduce dependence on the US. They're investing trillions in homegrown tech, aiming for self-sufficiency in everything from chips to AI. Rising wages mean China is no longer the cheapest option, so they're moving up the value chain: less toys, more tech. Geopolitical tensions over Taiwan, the South China Sea, and human rights make US-China trade risky. Companies are diversifying, moving production to Vietnam, Mexico, and beyond. The result: China is deliberately reducing exports to the US, building its own economic bloc, and treating America as just another customer. This isn't a temporary dip, it's a fundamental shift. China wants to control its own destiny, and the US is no longer at the center. The global supply chain is being rebuilt, and America is increasingly on the outside. The message from Beijing: we're uncoupling and we're not looking back. For US consumers, that means fewer cheap imports and a new era of economic competition. The world's biggest trading relationship is being rewritten in real time, and the ripple effects are just beginning. Now, let's talk about Mexico, America's neighbor and longtime trade partner. When US companies fled China, many turned to Mexico for cheaper, closer manufacturing. But the transition hasn't been smooth. Mexico's government has taken a nationalist turn, making foreign investment riskier and sparking trade disputes with the US. Political unpredictability and security concerns, like cartel violence and cargo theft, add to the uncertainty. These issues make companies hesitate to invest, slowing the flow of goods north. The result: supply chains are less stable, and prices for everything from cars to produce can spike overnight. The auto industry is especially vulnerable. Parts cross the border multiple times, so any disruption halts production. Mexico's potential is huge, but instability is holding it back. For the US, that means higher prices and more supply chain headaches. Mexico is both the solution to our China problem and a problem itself. The relationship is more complicated than ever, and its future is far from certain. Across the Atlantic, Germany and the EU are rethinking their trade with the US. The EU's new mantra: strategic autonomy, less dependence on America, more focus on their own market. Tariffs on European steel and aluminum during the Trump years shook their trust in the US as a stable partner. Now the EU is building its own economic fortress, prioritizing internal trade and new deals with other regions. Regulations are a big part of this shift, like the EU's carbon border tax, which makes US goods pricier in Europe. Energy shocks from the war in Ukraine have driven up costs, making German exports less competitive. Some German companies are even building factories in the US to escape high energy prices, ironically reducing exports from Germany. Political differences over data privacy, tech regulation, and taxes add more friction. The EU and US are drifting apart, not in a dramatic breakup but a slow, steady divergence. Germany is tying its fate to the EU, not the US. The result: fewer German goods heading to America and a more self-reliant Europe. The transatlantic trade relationship is cooling, replaced by a new era of economic blocs. The US is no longer the center of Europe's economic universe. The rules and the players are changing, and America has to adapt. Japan's trade with the US has always been strong, but it's evolving fast. Tariff threats, especially on cars, made Japan realize it couldn't rely solely on the American market. Japan responded by leading new trade blocs like the CPTPP and signing deals with the EU and Asia. The goal: diversify so no single market, especially the US, can hold them hostage. Japanese companies now build millions of cars in the US, which means fewer exports from Japan itself. This shift protects them from tariffs but changes the trade numbers. Japan's aging population and economic stagnation also mean less export-led growth. The focus is now on high-value goods, tech, and overseas investment, not just shipping products abroad. Japan isn't breaking up with the US, it's just making sure it has options. The lesson in a world of unpredictable trade policy, diversification is survival. America is still important, but it's no longer the only game in town. Japan is quietly building a new global trade web, and the US is just one node in it. South Korea's export story is all about technology and geopolitics. Korean giants like Samsung and Hyundai rely on both the US and China, but the US-China tech war has put them in a bind. The US wants Korean chipmakers to limit business with China, but China is their biggest customer. Pressure from both sides forces Korean companies to rethink where they build and sell. US incentives encourage them to build factories in America, but that means fewer exports from Korea. The Inflation Reduction Act also pushes Korean automakers to make EVs in North America, not Korea. Tariffs and quotas on steel and ships have driven Korean firms to seek new markets outside the US. The result: less direct trade, more local production, and a fragmented supply chain. South Korea is caught in the crossfire, forced to choose sides in a tech war it never wanted. Every major industry, from chips to cars, is affected. The US-Korea trade relationship is now shaped by politics, not just economics. For American consumers, that means fewer Korean imports and more uncertainty. The tech war is redrawing the map of global trade, and South Korea is right in the middle. India is emerging as the next big player in global trade. As companies look to diversify from China, India's young workforce and low costs make it a top choice. Apple and others are ramping up production in India, but scaling up is slow. Logistics and bureaucracy are still hurdles. India's fiercely independent policies mean it won't just be a US proxy, it's balancing ties with both America and China. High tariffs and Make in India rules protect local industries, making US-India trade tricky. Trade deals have stalled over these issues, limiting growth for now. But if India succeeds, it could become a major alternative to China, reshaping global supply chains. For the US, that means a new source for goods, but also a more complex, multipolar world. India wants to be more than just a factory. It's investing in tech, space, and its digital economy. The rise of India will shift the balance of power in global trade. The elephant is waking up and starting to run. Where it goes next will shape the world for decades. The US must adapt to India's rise or risk being left behind. The future of trade is no longer just about China. And then there's Canada, America's reliable, resource-rich neighbor. While others pull away, Canada is doubling down, signing massive deals focused on critical minerals and electric vehicles. The world is going electric, and batteries need minerals like lithium and nickel, most of which come from China. The US wants to secure its supply chain, and Canada has the resources. New investments are building mines, processing plants, and battery factories across Canada. This is friendshoring in action, moving supply chains to trusted allies. The Inflation Reduction Act makes Canadian minerals and EVs eligible for US tax credits, deepening integration. Canada gets a guaranteed market, the US gets security and stability. This isn't just about lumber and oil, it's a strategic partnership for the industries of the future. Canada's move is the flip side of global de-risking. As others step back, the US and Canada step closer. Together, they're building a North American supply chain to counter China's dominance. Canada isn't bucking the trend, it's leading it. So what does all this mean? The old model of globalization is over. The new game is about security, alliances, and trust, not just price. Countries are building blocks, reshoring, and friendshoring their most critical industries. For the US, this means rebuilding manufacturing and supply chains with trusted partners, but it won't be easy or cheap. We'll see higher prices and more disruption as the world splits into competing blocks. America must balance investment at home with smart diplomacy abroad. The choices made now will shape jobs, prices, and prosperity for years to come. The rules of trade are being rewritten. Are we ready to play?